you've got all these names for bad down moves. What about for up moves? Do you get a bull market, a double bull, a rampant bull, a raging bull? I mean, gosh, it's so exciting, all this stuff. I can hardly control myself.
For those of our listeners that have watched the movie The Big Short, so Burry's betting against Nvidia, and Deutsche Bank is saying they might sell a basket of these AI stocks to hedge themselves. Just some echoes of 2008 there.
But let me give you a little insight into some of the terminology that equity investors use. You'll love all these, Rich, because they refer to when things go down.
Does that mean I get to eat my bird?
You get to eat your words.
Eat your words.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 18 of the UK's #1 financial markets podcast, The Art of Investing, brought to you by IG, the global investing platform. Now, we are going to take advantage of my good colleague's experience here, Mr. CJ Fellingham and Mark Spice Holden. They've been around to see a few budgets in their time. And as the heat builds on Rachel Reeves this week, ahead of the budget in 3 weeks, we thought we would ask the gentleman here, what happens if a budget goes wrong? Now, before we go on to that and looking at the portfolio review, we go straight across for the Spice Market Review.
Thank you, Rich. So it's been another difficult week for cryptocurrencies. They've had a real sort of fall. We deem it a correction, and I'll come on to explain some of the terminology that people use in markets. But crypto basically has had the correction, a 10% fall in overall, led by Bitcoin this time. There were many other coins that did a lot worse than that. And Bitcoin is now in a bear market for the year to date so far, which is pretty impressive. So that bear market is a 20% fall. But let me give you a little insight into some of the terminology that equity investors use. You'll love all these, Rich, because they refer to when things go down.
Does that mean I get to eat my bird?
You get to eat your words.
Eat your words. Absolutely. So equity guys will talk when markets fall between 3 and 5%. That's called a dip. Not a lucky dip, an unlucky dip, I guess.
And that's what you like to buy.
Exactly. I like to buy the dip, as many people do. And those happen about 4 to 5 times a year on average over the last 100 years. You get those sort of small pullbacks. They're considered quite healthy. When you get a pullback, which is the next sort of level up, that's a fall of between 5 and 9%. And those happen maybe once or maybe twice a year. And then you get a correction, which is what's just happened in the crypto market and Bitcoin. And that's where you have a 10% fall. And those happen again once every year or one and a quarter years. But anything more than a correction, more than 10%, gets to 20%. And that becomes a bear market.
Ooh,
where Rich
official.
Can't stop smiling during bear markets. Now, sometimes you get a crash, which is a fall between 10 and 20%. But in a couple of days, it happens very quickly. And that can be very painful. And you could actually argue that the crypto fallback this week has been almost a crash. And certainly over the last month, there's been some pretty horrendous falls in cryptocurrencies. So I say Bitcoin actually entered a bear market for the first time this year, having fallen from its highs about 20%.
Mark, is this a latest fad to call market moves by names? I mean, if it goes down a little bit, it's this. If it's a bit more, it's that. If it's this, it's that. I mean, what is going on? When I was a young investor in short trousers, we never define things by this. The market goes up and market goes down, and that's all that's there. I mean, what happens if it goes down 45%? Is that a double bear? Or is that a polar bear? I mean, what is going on, Mark?
That's because they spoke Latin in those days. We developed the English language since.
Thank you.
Of course, the bond guys never see big falls, do they?
They just go, this is a bond thing.
Yields are rising. Yep. Prices are falling.
Yep.
Yes, but they don't define it. But equity guys do. We've got to have some fun. We're optimists.
But this is something that's happened a lot in the old days. I mean, this isn't just a new fad.
No. I mean, I've been in the market about 40 years. And yes, it's one of the things you learn very early on when you start sort of covering markets. Yes, dips, pullbacks, corrections, and bear markets.
But it's really been since the financial crisis that this terminology of buy the dip has come in, because the central banks have always been there to assist you. So just buy the dip is a relatively new one.
Yeah, I mean, there's a whole generation of investors out there, professional and amateur, that have learned that every time the market pulls back and falls, 5-10% or whatever, it is right to buy the dip. I mean, this year we had a bear market in the S&P 500. It fell 20%. NASDAQ fell over 20% back in April, if you remember, when Trump introduced his tariffs, Liberation Day-led tariffs. The market fell 20% very quickly. But buying the dip then proved to be absolutely the right thing to do. Since then, the S&P rose over 30%, NASDAQ up over 40%. And there's a whole generation of people out there have learned that every time it goes down a lot, it's a great opportunity. And, even this week, on Monday and Tuesday, they tried to get the markets down, and we'll talk about it later, but there are lots of high-profile investment bankers out there talking markets down and saying how expensive things were. The markets went down 1.5%, 2%, and buyers came in. And they've been buying for the last 2 days, and we're back up pretty much to where we started the week.
And so my last question on that would be, you've got all these names for bad down moves. What about for up moves? Do you get a bull market, a double bull, a rampant bull, a raging bull? I mean, gosh, it's so exciting, all this stuff. I can hardly control myself.
Well, a bull market is a 20% move higher, okay, right? And then, as you would often refer to, a bubble becomes things that are much bigger.
The bubble appears.
Yeah, and bubbles and bulls.
The bubbles after the melt up.
Okay. Yeah. All right, so let's...
so the bulls are always blowing bubbles.
Okay.
If you're a West Ham supporter, you'll understand.
Yeah, that's where it comes from.
That was the main feature of the week. As I said, it didn't really affect equity markets, but the market that did really well again this week was the FTSE 100.
Go on, the FTSE. Now, can we have hats made, Mark, for FTSE 10,000 before it gets there? I'm not sure we could get it that quickly, because it looks really good to me at the moment.
Well, I'm looking into those hats, but I don't think the delivery times are quick enough, hopefully. But yes, no, the FTSE 100 hit a new all-time high. And that was helped by the fact that the pound went down again. There's still seems to be a steady withdrawal of money from the UK ahead of the potential, the budget at the end of the month. And international investors particularly running a bit scared. Interestingly, the dollar has been quite strong, and the dollar's moved up about 3 or 4% in the last sort of 6 weeks or so.
And that has hurt our commodity positions a little bit.
It has. But, we haven't done that badly considering this dollar has been going up. Because ordinarily, if you remember, when the dollar goes up, commodity prices go down, which I'm sure you're referring to there, Reg. Yeah. Talking about commodities, just because we talked about oil a couple of weeks ago, we don't have it in the portfolio, but it's just worth mentioning that OPEC and OPEC Plus, which includes Russia, had their meeting at the weekend, and they've decided to, as expected, increase their production a little bit more, only by less than sort of 1% of less than sort of 0.1% of the oil market in total. And now they say they're going on pause for the first quarter of next year, and their next meeting isn't until February. So the oil price now will just be open to the vagaries of normal supply and demand. Corporate results, we are still in the midst of the reporting season. It's been a pretty more mixed week this week, I guess. But in overall, still results are net pretty good. And the ones that have been really sort of eye-catching, in the UK today, even today, we had BT, Sainsbury's and AstraZeneca. Remember, AstraZeneca is the biggest company in the UK. They had pretty good results. All the shares are up a little bit on the back of it, which is good, rather than being down a little bit, but not big moves. And the one company that disappointed today was Diageo, who own Guinness and Johnny Walker whiskey, etc. So a lot of you will have helping Diageo with their profits, but you're not doing a good enough job because they disappointed a little bit. But across the world, we've had very good results from the car rental company Hertz. And we've had good results from the banks. The banks across the world actually have had a pretty good reporting season. In this week, we've had them from Deutsche Bank in Germany, Santander in Spain, all pretty good, and their shares rose sort of 4 to 5% on the back of it. On the disappointing side, we've had Meta, who owned Facebook. Their shares have fallen about 17% over the last few days after their results.
That's right. What does that mean? That's not a bear market. That's That's a correction on top of a setback, on top of a
poor set of results.
Well, Rich loved it, which is why I put it in there.
Yeah.
But as Rich actually, one of his concerns, to be fair, is that he's worried about the overspending on AI not giving you a return on that investment yet.
Exactly.
And we said that you're not going to know that really for 6 to 12 to 18 months probably. But Meta was, it's interesting as a Magnificent Seven company to disappoint a little bit on that side.
I think the reassuring thing there is the market is no longer rewarding these ridiculous promises years into the future. It's now saying, no, we want a little bit of balance sheet discipline in these plans for AI. And that's why it's been hit so hard.
Yeah. I mean, as we said before, the good thing about these companies spending on AI is most of it is coming from internally generated cash flow rather than borrowing off the banks, which is where it gets more worrying. But there have been a whole range of other results this week. Chipotle, who own the Mexican fast food chain, their shares were down 16%. They're struggling. Anything exposed to the US low-end consumer have had a difficult time. If you remember, we are now into the 6th week of the US government shutdown. That is now the longest on record. So Trump did the last one, and this is now the longest on record. So it's been going 6 weeks. And so we're lacking data about the underlying economy. Now, we have had some. We had some from ADP Jobs Report, which is an independent company who process payrolls for I think is about 1/6 of all US companies. So it's a huge sort of payroll company, and it tells you roughly how it's doing. Now, they saw actually jobs grow by about 42,000, which is good because if you remember the last few times we've talked about jobs in America, they've been shrinking. So that was positive, and it was a bit better than expected. But we still don't know the true underlying picture because of this lack of data that's come because of the government shutdown. Now, some people are estimating that if this carries on for another month or so, that could affect fourth quarter GDP or gross domestic product or growth, if you like, in the US economy by about 2% in the fourth quarter, which could be quite material. Yeah. Now, a bull like me would say, well, that's great. It gives the Federal Reserve, the central bank, an opportunity to cut interest rates because they're worried about the underlying growth. Because not all of this growth will get back, even when the government shutdown finishes and people go back to work, because most of them are furloughed at the moment. But, there are pockets of signs that the economy is struggling in the US. McDonald's this week, great results. I obviously helped them with that. But the underlying picture for their lower income visitors who go into their shops, they were seeing that their sales to lower income people were down about 10%. So it really is biting, and it's hurting the people on the lowest incomes, which of course is a great shame. So hopefully this will come to an end soon, but there's no real sign of it at the moment.
Now, Spice, is there a chance we'll get another live interest rate decision before the end of the programme today?
Well, as a bull, I would hope that there will be an interest rate cut from the Bank of England, who have their Bank of England meeting today. Last time, if you remember, there was a split in the decisions. There was split 7 people who wanted to keep interest rates the same in the UK, which they did, and 2 people who voted for an interest rate cut of 0.25%. Let's see what happens today. There are some people suggesting that that shift may be 6 people wanting a hold and 3 people wanting a cut. But we'll see at 12 o'clock, and we'll probably, if there is a change, we'll bring it into the podcast at the end of today. Finally, I just wanted to talk a little bit about some headlines that you will have read, that the US Supreme Court is started hearing arguments about whether Donald Trump's tariffs, which he imposed back in April, are legal. He has used a power, which is called the International Emergency Economic Powers Act, or IEPA. Let's say that quickly, IEPA.
It goes back to your Chipotle.
Exactly, yeah. I'm not very good at those pronunciations. And to see if that's legal. Now, there's no decision, and not at the moment. And we're not likely to hear a decision maybe until January 2026, at the earliest likely. But there's a chance that gets dragged out even to June next year. Now, markets won't really trade on those. They won't worry about these things until they come to pass. And even if the Supreme Court blocks some of these tariffs and deem them illegal, there are other ways that Trump can impose these tariffs. The obvious one is to go to Congress and put through a bill saying they want to do tariffs. Now, if Congress approve it, that can happen. And he does have a small majority in both houses, but it's very wafer thin. So it only needs a couple of people to fight back against him, and that could take time. And we see how difficult it is for them to get a budget across the line at the moment.
Yeah. And I suppose not wishing to alarm anybody, but the other way is he could just ignore the Supreme Court. And there are various, people who would say that, this is his right to do these tariffs, and therefore if the Supreme Court tells him he can't, then this is an area that that he should explore. I mean, clearly that's very dangerous, and the markets will not like that at all. If he says, I'm ignoring the Supreme Court, I'm just doing whatever I like, I think we could have a little bit of a mess on our hands. Very unlikely, but this is something that we'll have to keep an eye on.
But yeah, most importantly, nothing to take into consideration for our portfolio until the turn of the year, at least.
Absolutely. And the markets that will most be affected by those will be either countries that have very big tariffs sort of levied against them, like India. For example, if the tariffs were deemed, sort of illegal, India are currently paying a 50% tariff. So we've got a position in India. That would actually be very good for the Indian market if that was abolished and they had to go back to normal. Wouldn't be so good for some of the US companies, particularly the smaller companies. Actually, it might hurt our Russell 2000 because the bigger companies can brush it off. They don't really worry too much about the tariff side. But the smaller companies in America who are involved included in the Russell 2000, which we own, they could be negatively impacted. But like I say, equity markets won't worry about this until either we get an outcome, which, like I say, won't be until January, probably at the earliest, maybe even June. So there's nothing to worry about in our portfolios at the moment.
But it would blow the budget apart, right? That would take the federal debt up towards that 40 trillion level.
One might argue it blows the budget apart. On the other side, you might say inflation will be a lot lower in the States, because there's now no tariffs. Yeah. So, there'll be lots of people with different stories. Like, normally when these things happen, it's vastly overestimated by what the effect will be, as we have seen from the worry about tariffs in the first place. I'm more concerned, as I said, as to whether he says to the Supreme Court, I'm sticking two fingers up at you, because that's really worrying. I don't think he would. But, there are people who say, this is your right, you should be able to do this, and therefore that's what we should do. Unlikely, something to watch, I think, is in that category. I've got three other things just to quickly mention. Mark talked about crypto earlier. Crypto's a complete mess. People have been highly leveraged in crypto, not just because that's what crypto people do, but because the Trump administration has been very, very positive on crypto and saying to everybody you should be involved. So everyone's been involved, and they've just been absolutely spanked. And
that's a technical term.
That is a technical term.
Where does that?
I know the one.
Yes, spanked. Yeah.
Oh, yeah.
And we got plenty of those for later. And so it's just trying to get some confidence back. But it is a little sign that where there's leverage in the market, it's getting found out at the moment. So that's just something to file away in the back of one's head. Second one is bonds. People haven't been talking much about bonds. Most of the information that's come out over the past few weeks has been market-related information. There's been no economic information. As Mark says, the US government being shut down means most of this stuff doesn't come out. But the bond market has backed up about 20 basis points. So that's 0.2%. And remember, when I say it's backed up, I'm talking about yields being higher. And if yields are higher, guys, where a price is?
Lower.
Thank you. But we're still within a range. It's nothing to shout about at the moment, but it's something, once again, to keep on your agenda. And the final thing I wanted to mention was Mark indicated earlier about AI and the amount of money being spent on AI and where the money's coming from. I thought it was very interesting that in this week's results for Deutsche Bank, Deutsche revealed that they were looking at how they could hedge some of their exposure to this stuff. I'd say that's a positive, because normally if they were really, this is brilliant, they wouldn't hedge any of it. Well, that's what's happened in the past.
You probably want to explain hedging just in that sense.
Okay, so Deutsche Bank and other banks have exposure. What I mean by that is they've lent money to these companies for them to go and use that money to go and spend on data centers or whatever else they're spending on. And they'll look at their portfolios and see how much money they have lent to these areas and say, is that too much? Am I taking too much risk there? What I regard as quite positive here is that they're at least thinking about it, which is something they haven't done in the past. What could they do about that? Well, that's the hedging that we just talked about. What they could do is they could take a position in a market which is not exposed to AI, or even they could short, they could sell shares in AI companies on the basis that if the lending goes wrong, those share prices will fall. So what they lose from lending, they'll make back on the stock prices falling. So they're just talking about hedging and thinking about that exposure. I just think that's quite positive compared to where we've been in the past, where people just don't care about this stuff and go in maximum long.
So those of our listeners that have watched the movie The Big Short, there have been a few echoes of 2008 this week. The first being that Deutsche Bank, of course, did a very good job of hedging their exposure back in 08. So people, when they saw the headlines this week, they thought, right, these are the guys that got it right back in 08. So, if they're...
You're talking about the financial crisis in 2008.
The financial crisis.
Yep.
So these are the guys that spotted the subprime lending problem early in 2007 and decided to hedge that exposure. And Deutsche came out as one of the best from the financial crisis. If they are the ones that are spotting a potential problem in AI data center infrastructure spend, and they again want to hedge by shorting the AI equities and basically the NASDAQ, then I think that was just started to put a few alarm bells into people's view. And secondly, the same day you had Michael Burry, of course, saying that he had put big downside bets on the share prices of my favorite bear position, Palantir, which also had numbers this week. I see our bull decided not to mention that one of the biggest stocks had fallen 15% after it reported numbers, and Nvidia. So Burry's betting against Nvidia, and Deutsche Bank is saying they might sell a basket of these AI stocks to hedge themselves. Just some echoes of 2008 there.
Well, let's talk about that all in a moment. But let's go to the portfolio first. Talk about that, because I'm sure this will come up again within our normal conversation about what we're feeling.
Okay, so it's that time of the week when we review the portfolio. We touched above 10% target for the year last week, but oh dear, we have sunk right back below it with a down 1.2% performance on the week. However, still leaves us up 9.4% since inception. What were the big winners and the big losers of the week? Well, gold helping us to a 1% gain on the back of that this week. And the FTSE with those new all-time highs, delivering a 0.1% return. So it is all about those losers. And as Spice mentioned in his review, a stronger dollar has taken the copper price lower by 4% on the week. It's also hit the crypto and blockchain innovators ETF, down a similar 4%, but still up 49% since inception. Then we've got our mining trust. So you can see where the losers are this week. It is in the commodities section, with the mining trust also down 4%, Russell 2000 down 3%, and then the S&P down 1.5%. Chairman, what's your thoughts on this week?
Well, I mean, it's clearly disappointing to lose some money, but we had such a great rise the week before. I think we'll take that as just noise in a sense. I thought there was one excellent headline I saw today, which just puts a little bit more worry in my mind, and makes me wonder whether we're getting close to the top of this market for the moment. And that was actually in the FT, where it said, "Are bubbles good, actually?" Now, when people start saying that, it's very nearly saying it's different this time. It's getting close. The argument being, of course, and I know Mark, my bullish friend over there, would take this argument that actually the bubble nature, the mania nature of some of these things brings more capital in, but it really encourages innovation, drives things forward. And so actually the net effect for the public over time is really positive. But I'm not really caring too much about what it's for the public over time. What I'm caring about is what it does for my portfolio. Mm-hmm. And there aren't many bubbles which leave portfolios in a better position than they started. So the issue to me is, as always with bubbles, if you get in and you get out before the bubble bursts, that's fantastic. If you get in and you don't get out in time, then you will have a problem. And of course, with this portfolio that we're running here, we only do a weekly podcast. Some say thank God. And we deal on Friday's close. So any decisions we take, we have to think that the time lag's there and that we might not hit the high every time or the low. And so we've just got to be careful. And I'm feeling a little nervous this week, and I feel like there might be something that we should be doing. But let's just open that up to you guys. What did you guys feel?
Well, I've got a poem for you this week, actually. Spice. So
is it Wee Tammany Beastie or whatever? The Scottish lot.
It's not going to be a Buddhist poem, is it? Let's be honest.
And it just reminds us, of this euphoria that builds in a bull market. And you never really feel the pain until it's in front of you. So this is from Aaron Singhal, and he is a chief investment officer of a global macro fund. So an economist like we've had on, but one that actually uses his skills to make money. Then brokers marvel at the rates, while merchants dock their spacious freight. Debt becomes the ladder up the wall, till interest comes and sees the fall. Yet afterwards they patch the rent with public acts and government consent, while private capital lies in the tomb and memory marks the spacious bloom.
So you see, that sounds a bit like Macbeth to me. With a
he was Scottish as well.
When will we three meet again in thunder, lightning, or in rain? Anyway, thanks very much for that poem. Spice, what's your response to that?
I think the interesting thing in that poem is he would be right if AI companies, he was saying basically debt goes up, then interest rates go up, and that blows the bubble off. Well, I'm afraid, as I've said before, and one of the reasons I don't believe this is potential bubble that's ready to burst yet, is that basically companies are funding this growth in AI through their own internal cash flows. And I've said it several times, and it's like a record that's broken. But at the same time, interest rates are not going up. They are actually going down at the moment. Now, that may ebb and flow, but markets are still expecting the interest rates go down. Now, I would be worried if interest rates were starting to go up at this point.
Like they did this week.
No, they haven't got up. They haven't. Bond yields have gone on.
Hold on. So just define. When we've talked on this podcast, we talk about interest rates. So let's be clear. Are we talking about interest rates, or are we talking about bond yields? Now, remember, for our listeners, the bond yields are the longer dated bonds, or longer than the 1 or 2 year bonds, longer than in the very short term. So, what is it you're saying you would be worried about? If they move base rates, effectively the equivalent in this country, or whether bond yields rise? So
I am referring to interest rates, base rates that the Bank of England set, the Federal Reserve set, and the European Central Bank set. Those are still on a downward path. Now, the UK probably won't cut today, but then if they don't cut today, they probably will do in December. The trouble with the UK has got 3.8% inflation. It's the highest in the G7. But, our economy is bouncing along the bottom.
That's been priced into markets.
I know.
That's why we're at the all-time highs.
Yes. Well, you like the FTSE. So you're saying sell the FTSE?
No, I think the FTSE's got a great defensive play, but the S&P 500 already has 4 rate cuts priced into it.
Yes, and we're in the midst of those. Equity markets rarely go down when interest rates are being cut and the underlying economy is okay. Now, I'm not saying the underlying economy is shooting its lights out, but I think it is actually, the US has the strongest growth out of all the G7. And basically, because of the One Big Beautiful Bill, because of the AI spend, here we go again, and the interest rates being cut.
Which is all priced in because it's all known about.
But it's not, because markets are still hitting all-time highs.
So who doesn't know about interest rate cuts and the Big Beautiful Bill?
So when has that ever stopped markets going higher? When has it ever stopped? For bear markets to happen, there needs to be an event. There needs to be a catalyst for people to go, oh my God, it's all over. And we aren't anywhere near that. Now, there are warning signs. I totally agree. There are things that you need to be worried about. We need to keep an eye on, and we need to be nimble. Now, we are nimble. We meet every week. We can trade every week if we can. But at the end of the day, markets, you don't want to stand in the way of this momentum. And you make your most money in bull markets and bubbles in the very last phases of that. That's when these things can go exponential, which you keep talking about. As I said to you the other day, NVIDIA going up 10% is not an exponential move. Going up 50% in a week or two is exponential. And we're not seeing that.
Yeah, when stocks are already priced at $5 trillion market cap, that cannot happen. A 10% move was a 500 billion increase in market cap. You've never had that in 2 days before in history. Well, that is exponential on market.
You are thinking monetary terms. You're not thinking percentage terms. If you remember, as I said to you before, if you go back to what happened at the internet bubble, Cisco was effectively the Nvidia of its time. Cisco was trading on a forward price earnings multiple of 220 in March 2000, just before the bubble burst.
Which is the same as Palantir is today.
Palantir, I'm not arguing with you about Palantir. I don't like the company much either. But Nvidia is only on about 30, 35 times.
No, I agree.
So that it's not a ridiculous valuation by any stretch.
I agree that Nvidia is not in the eye of the storm. It's not going to be the catalyst. What could be the catalyst, Chairman, that makes you a little bit worried? And can we even see what the catalyst would be?
Yeah, I think that's a really good point, Rich, because when I look back with my many, many years in the market and I look at the crises we've had, most of those crises have come up on us without us really realizing what the crisis was as bad as it was going to be. The perfect example to me would be the financial crisis in 2008. Now, I'm sitting there at one of the biggest bond houses in the world, trading fixed income bonds, both corporate, you remember Chris Bowley talked about corporate bonds last week, and government bonds. The signs are on the wall that things are going wrong, but you're not quite sure what's doing it. And then you find in the background, there's this subprime mortgage problem, which if you've been involved in the mortgage-backed security market, you know all about. But if you've not been involved in that, if you're an equity guy looking at the oil companies, or if you're a government bond dealer, you don't know what those things are. So to me, what will get to us, what will happen is not something obvious like Nvidia or something like that. I'm with Mark on that. It won't be something like that.
Yep.
It's going to be more like, in my book, something going wrong in the private debt space. Something like that, which is hidden. You can't see it until it affects. And that's why this crypto thing worries me, because there's clearly pain in the crypto world. People have borrowed too much money and they are getting margin calls, essentially. And that's what's causing these things to be very difficult. That's what you normally see at times of crisis starting. So I'm concerned about that. I am not concerned about the Nvidias of this world. But I do think we should do something, because I think we should look at our portfolio and say, what's in our portfolio that's really there just making up the numbers rather than something we really believe in? Mm-hmm. And my eyes go straight to the DAX holding. We're holding DAX. None of us really thinks that much of the German stock market. Apart from that, they're going to borrow a load of money and pump it into the economy, and we think that's bullish for Europe. Mm-hmm. But Europe generally isn't going to be the biggest growth area in the world. We know that already. And therefore, my recommendation would be, and it's a bit of a softy type thing to do, but I don't want to sell the other things, but I want to reduce my equity holdings. Mm-hmm. And the reason is because when I think about risk, and I say this to everybody who's listening to this podcast, when you think about risk, you're thinking about really, if the market was to fall 10 or 15% tomorrow and my stocks all fell, how upset am I going to be? And you need to work that out in your mind. Now, to me, I'm pretty happy that we've got the FTSE. We really like that. We've got the smaller companies, UK. Yeah, they'll come off as well, but I'm quite happy with that. I'm holding the DAX, and I don't know why I'm holding it, really.
Yeah.
So I'm going to suggest we sell the 5% DAX into cash and review it again next week and see how we're feeling then.
I mean, if you remember, the reason we bought the DAX was because we were expecting this increase in fiscal spending on defence, principally, for the first time since the Berlin Wall came down in 1989. Yes. And the last time the German market really outperformed other global markets was back in the early 90s, as they were doing exactly that. They were unifying East and West Germany,
lots of money coming,
spending loads of money, pumping loads of money for the first time ever. And that really helped their stock markets. And the other thing was if there was going to be peace in Ukraine and Russia, because Europe being right on the border of Ukraine, if that war finishes, the biggest companies to benefit from a rebuilding of Ukraine and from the terrible sort of bomb wreckage, that would help European companies more than any others. And that was the basic thesis. Now, the chances of that peace deal, I would say when we first put the portfolio together, were probably 50-50. Trump was being quite vocal. He was about to meet with Putin, and that was looking pretty promising. Now, Since then, the chances of that deal has diminished quite materially. And I would say there's only probably a 10% chance as we look at things at the moment. Now, if we thought the odds on that were going to increase again to over 50%, I'd say let's have more to that, not less. But right here, right now, that reason has diminished quite markedly. And therefore, I'm not going to fight it that much. I've said before, you want to water your flowers and cut your weeds. And the DAX is a weed at the moment.
Okay, let's do that in the portfolio then.
Okay, so we are selling 5% holding of the German DAX equity ETF, and we will put that into cash. So that takes our cash up to 7.5%, which makes me feel comfortable because that's a nice buffer. In addition, we've got a 10% holding in gilts, which is pseudo cash at this moment. So 17.5% cash or cash equivalent holding. That gives us a really nice buffer. If markets are to drop, we'll have something to then reinvest.
I think it's right to think that if they are to drop here, I'm not thinking it's a bear market drop. I'm trying to remember the language.
It's a correction in a bull market.
And therefore that's when we would use it.
And it's also exactly what David Solomon of Goldman Sachs called for this week as well. He said it's inevitable. We're going to see a 10% correction or 20% drop. It's just hard to tell when.
I mean, you've had some of the, as I said earlier on, some of the biggest executives in investment banks in the world this week. I mean, you've had Ted Pick, the chief executive of Morgan Stanley. You've had David Solomon, as you say, from Goldman's. You've had Jamie Dimon, CEO of JP Morgan, probably the most respected investment bank in the world. All of them saying that valuations are stretched. And yes, they are stretched. They would all like it to see the markets correct a bit or dip, because that would take the froth out of some of the markets. And I would like to see that as well. But the fact that all these people are saying it all the time means that markets have a habit of doing exactly the opposite. And that's why it's painful. If you're out of the market and you wanted to go down so you can buy it, you're not getting the opportunity. An opportunity on Monday or Tuesday where, NASDAQ fell 2%. People go, oh, go down further, then I'll buy it. It didn't. It went straight back up again.
So I think the point we're making, and I don't disagree with any of that, is we're not trimming this because we naturally expect a fall tomorrow or the next day. We're just saying when we look at the overall exposure to equities, the valuations that are where they are, it might be a little bit sensible to take a little bit more out and just run a little bit less full-blown equity exposure.
We're being prudent, Mr. Chairman, sir.
Thank you very much, sir.
So on to our special topic of the week, and we've started seeing more and more headlines, even Rachel Reeves coming out this week and saying, well, we know we said we weren't going to increase taxes, but now we're not sure whether we can promise that anymore. Mr. Chairman, sir, what are we starting to think about the upcoming budget?
Okay, Rich. Look, we're going to have a number of episodes on the budget. And we're going to be lots to talk about regarding the budget afterwards as well. In our podcast 20, remember this one is podcast 18. In our podcast 20, we will have a special guest who will come in and will help us to exchange our thoughts on what we think will happen in the budget the week before. So today, I wanted to just do something a little bit different. I think this budget is going to be a defining moment for the government. Personally, I think it's a great opportunity, but we all know people take opportunities, people don't take opportunities. So today, what I wanted to do was to try and explain why this budget's so important and some of the fallout that can happen if the Chancellor gets it wrong. I'm going to do a little bit of a background, or as some say in the podcast world, an explainer. When I started in the city, the budget was always on a Tuesday afternoon, and it was always in March. Now, only people who watched the gilt market bothered listening to the budget. Right. So we would sit there, there would be one TV screen in those days. You didn't have a TV screen on every bank or every desk. It was one up there, and up would come the Chancellor, and the Chancellor would drone on for hours. And we would have to listen to every word. Fortunately, by the time the Chancellor sat down, the market had closed for the evening. And therefore, it couldn't react to what he had said, which by the way, I actually think was quite good. It would have saved me a lot of money because, as I said on this podcast many times, the first reaction to an event is usually wrong because the devil is always in the detail, and that only comes out when the Chancellor sits down. So things have now changed from a budget in the spring and an autumn statement 30 years ago to an autumn budget and a spring statement. Now, why has that changed? I haven't got a clue. I expect some bored civil servant thought it was a great idea and thought, I've got to justify my salary somehow, so let's just switch these things around on a regular basis to keep us all guessing. I can't see why you would change it, but we now have that situation of an autumn budget with a spring statement. So on Wednesday, the 26th of November at 12:30, so it's a Wednesday, 12:30, the Chancellor will stand up and give us a fairy tale on why she's having to put up taxes. You will hear a lot about the OBR. That's the Office of Budget Responsibility. And for those who don't know the history of the OBR, it was brought about by George Osborne.
Oh, right.
And George Osborne was trying to get away from the old practice of the Treasury effectively marking their own homework. So basically, the Chancellor would stand up and make some outlandish statements about this, that, or the other, and say, these are our forecasts. It was the Treasury's forecast. And since the policies were in charge of the Treasury, they were marking, it was all their own assumptions. Now the OBR has been set up and their job is to mark her budget against the fiscal rules she sets, which define how much we can borrow, how much we can have in debt, and where that ratio should be over time.
So that's why you guys in the gilts market were so focused on it back in the day.
What any Chancellor of the Exchequer says is to some degree irrelevant, because when they sit down, we'll know how many gilts are going to be issued that next year. What the gilt market is asking about is the growth that's going to come through from what she's trying to do, is it going to mean that debt pile over time has a realistic chance of being paid back?
Right.
And that, in a nutshell, is what it's all about. When she sits down on November the 26th, will the market say, gosh, there's a growth strategy here. We can see how this all adds up and how debt can be on a declining path over time? Or have we got a problem?
And by the way, it's the equity market worries about the growth profile rather than necessarily the amount of debt you have to borrow to fund that growth. That's in the first instance.
Yeah, and Mark was right in what he said, apart from the bit when he says worry, because the equity market never worries about anything, as we know. The equity market will just go with whatever the best story is. It's the bond guys who have to worry. But anyway.
The optimists.
Yeah.
Welcome to the boys.
So let's just look at something, because I think it's important for people to try and understand. Remember, this is all background. We're not trying to predict what's going to happen. Currently, the OBR projections, so the Office of Budget Responsibility projections, are that our debt to GDP ratio will hang around this 97% level at the moment, which compares favourably with the United States, which is at 122%, Italy, 135%, Germany, only 70%.
Big savers in Germany.
France, I'm just pausing there because I wanted I wanted some comeback from Mark, but I didn't get anything. France, 111%, and Japan, 255%.
I just wonder if there's a way for the listeners to resonate more with those numbers, because they're a bit meaningless, aren't they?
Yeah.
So I like to think of it as in, right, let's take people's salary, and then if they're lucky enough to get a bonus as well, so their total income per year. And then I'm looking at potentially buying a house at the moment. So I'll take that along to the bank manager, and the bank manager will offer me a mortgage, so my debt, of maybe 4 times my salary. And that's the way I like to think about it, of salary to mortgage being about 400% or 4 times relative to those numbers of government debt.
Yeah, so if we look at it on that basis, and clearly we're making a lot of approximations here and we're just trying to make it easy to understand. If you're wanting to borrow 500 or 600% or 6 times or 5 times your income, the mortgage company will say, well, maybe that's okay, but I'm going to charge you a higher interest rate.
Yeah.
And that's what's going on here with the government's borrowing. As the government's borrowing gets higher, the market says we're charging you a higher interest rate.
Because it sees it as more risky of being paid back in the future.
And at some stage, you might say, I want to borrow 10 times my income. And the bank says, no, I'm not going to lend you that. And so the danger is that if you keep borrowing more in the end, and now we go back to the government, the bond market says, I'm not lending you this money anymore because I don't see how I'm going to get it back. And so that shows you how interest rates moving up as debt moves up starts to become dangerous. Now, there's one other thing, though, that I think we all need to understand it, because when we look at the UK at 97% or say 1 times, it doesn't sound too bad.
Yeah.
In relative terms, it's actually quite good compared to everybody else. The problem is when you look at what's the definition of debt against GDP. And one of the things in the UK that's not spoken about a lot is that we have a massive unfunded pension liability. Now, what do I mean by that? The civil service sectors of the economy, the police, the nurses, and all this other stuff, their pensions are not catered for within our debt pile.
You mean people with real jobs?
So people with real jobs are not catered for within those numbers. So if the government recognised how much money they would have to pay out for those pensions, our ratio would be 3.3 times now. Okay, so right up towards the top end of these levels. So that's why our bond yields are higher than other people's, because the market understands there are issues here. And one final thing, the Office of Budget Responsibility have done a long-term exercise. Now, you can treat this with a pinch of salt, probably. I say probably. Just listen to what I have to say, then decide. Over the next 50 years, they have they've got a projection of where all this stuff will go to. And if they assume that we're going to spend more and more on the National Health Service, on healthcare, and they assume growth is going to be very stagnant, and they assume that we can't really move the tax basis up by more than where it is now, which is about 40% of GDP in tax, our ratio will be 270% in the next 50 years. So we go from 0.9, 97%, to 2.7 times, 270%. And that's without these unfunded pension liabilities. So with those on top, we would go to 5 or 6 times, or 500 to 600. And that is why it is really important that this budget answers all the relevant questions.
And so it's a real seesaw. It's how do I get the future economic growth higher without spending too much and taking on too much debt? And that is the real tricky balance that she's got, and what the OBR mark her report card, like you say.
I think it's more a question of the money she spends, is it spent in a way that creates growth, or is it spent on little political ideas and thoughts? I mean, and this could be Tories or Labour. This is not a political point, which doesn't actually create much growth. What we need is spending that creates growth.
Now, that's absolutely right, because you need that growth to increase the tax take, because people in that growth will have higher salaries. The companies will be getting greater profits, will be able to sort of pay more tax to the inland revenue. And that's good, and that offsets this deficit. Now, I think in this country, we are pretty skeptical about a government's ability to create growth, whereas in America, they are much more willing to believe that government actions, like the one big beautiful bill, will create growth. And remember, America's already growing at about 3% a year. We're sort of 0.5%, which is nothing. And they're already growing. Their tax receipts are already increasing. Ours are sort of bumping along the bottom. We really need to get that growth going to stand any chance of reducing these deficits.
Now, this is a subject we will return to not next week, but the week after when we have our special guest. But I just wanted to give 2 examples of when this process has gone wrong.
Yeah.
The first example is a very, very embarrassing moment for this country. And that was in 1976. And it was the time when the UK went to the International Monetary Fund, the IMF, for a bailout, normally reserved for third world countries. So let's just look at then and now. There are some similarities, but it was a long way away, I think, from this. But as a sort of example, so in the mid 1970s, UK was struggling with high inflation, peaking at nearly 25% in 75. Now we're not at the same level, but we had inflation of over 10% last year, and we're twice the target at the moment. The country had large fiscal deficits. And when I say fiscal deficits, I mean it's budget deficits. So how much the government borrows to fund public spending.
Every year.
Every year. And in those days, it was 10% of GDP. And now, at the moment, we've got 5% in the UK. The country also had a balance of payments deficit. Now, when I say balance of payments, I mean, when you look at what we import and then we look at what we export, if we import more than we export, we have a deficit. If we export more than we import, we have a surplus. Surpluses are generally regarded as better than deficits, generally. If there was an economist here, or if Stewie was here, he would be having a go at me now, but we'll just stick with that for the moment. In those days, the deficit was large at around 10% again, and it's about 4% today.
Okay, so everything...
We're in the same direction, but we're not as bad. Now, the government at the time was led by James Callaghan, and the government was deeply divided about how to respond to their problems. Spending cuts versus tax rises. Now, we're exactly in that camp now.
Yes.
They were exactly in that camp now. So you had the growing budget deficits, Fed is controlling inflation. By autumn 1976, they'd had a number of budgets which they hadn't done the right thing at. So it got towards autumn 1976, and there was a buyer's strike on government bonds. Government bonds in 95 yielded 12%, and they got to 17% in September of 1976. The government couldn't fund and stay solvent, so they had to go cap in hand to the IMF in Washington and say, please, will you bail us out?
Wow.
The IMF lent us $3.9 billion and said they would only do it. The conditions were significant public spending cuts, stricter monetary policy, because remember those days monetary policy was the government set interest rates, not the central bank. And then a whole host of food subsidy controls, price controls, and lots of things like that. At the end of the day, the IMF told us what we needed to do, caused lots and lots of spending cuts, lots of unemployment. Everything, though, recovered nicely because now the bond market yields fell back down again. So the government could then borrow money with the IMF behind, but the IMF made us do what needed to be done. And for those, Mark has mentioned her name on this podcast a number of times before, the direct consequence of all this was Margaret Thatcher getting in. And
so it had its benefits.
The reforms that happened after her. So here's a perfect example. Massive. We didn't do the right things. We didn't make sure our debt was repayable back or any feasible concept of it being repaid. The market said, I'm not funding you anymore. We had to go and get somebody's help. And the condition of help was do the decisions you're meant to do. Now, of course, you could argue that it actually helped the Labour Party at the time because they weren't prepared to make these decisions, but they had to, and they could blame it on the IMF. Now, let's just hope we don't get to that situation. I don't think we're there, but it's a salutary lesson.
So basically, you had a decade of over-celebrations after 1966. Winning the World Cup. And
I'm surprised you even mentioned that as a Scotsman. One of the interesting things about that time period was inflation was driven up because there was the Yom Kippur War in Israel. And that made the oil price go up 5 times what it was before. So the oil price went from a barrel of, remember we talked about Brent oil, and the price of that was just $2.50 a barrel.
Wow.
Now, remember it's $65 give or take at the moment. But back then it was $2.50. In the next 3 years, it went up to $12, then to $15. And that led to a massive stock market crash in 1974. Now, at the same time, Dennis Healey, who was the Chancellor of the Exchequer of Callaghan's government that you're talking about, gave a pretty poor budget. And he didn't match expenditure with the tax receipts. And the market punished him. So in 1974, the stock market fell 65% in the UK. The FTSE 100 fell 65%. And that was a complete disaster. It took a next year, it bounced back up. But then in the year where we got hit by the IMF, it did nothing. It actually went down a bit on the IMF announcement and then started to recover after that as they realized they were going to do the right thing. So stock markets quite often realize this earlier and do something about it. And then what comes first? Do they then scare the politicians to make the right decision, et cetera, et cetera?
So that's the first example. But there was one a lot closer to home and time. And that was the Liz Truss mini budget of 2022. Officially, it was known as the Growth Plan. How's that going now? It was announced on 23rd of September by the Chancellor Kwasi Kwarteng, and it was basically a large package of unfunded tax cuts and increased spending, and not much talk about cutting any spending.
So interestingly, our expert that's coming on the podcast in 2 weeks' time, just before the budget, was part of the Truss government in those last few days. So I wonder if we can get some of the inside stories from him in a couple of weeks' time.
Definitely worth asking him. We'll keep that line of inquiry open, Inspector.
As you say, Chris, I mean, there was basically a go for growth budget, which actually ordinarily would get stock markets really excited and really happy. They were going to spend £40 billion, but they didn't tell anyone how it was going to be funded. And that was their biggest mistake. I'm afraid that I'm going to have to use the word arrogant here, but the arrogance of the government or the department to not go and talk to the OBR, the Office of Budget Responsibility. They didn't even talk to them about how they would fund it, just assuming that they could borrow money from the government bond market, the gilt market, without any consequences, was very naive and very arrogant. And that quickly came home to roost because, as you say, the budget was on the 23rd of September. And government bond yields by the next day had gone up nearly 0.75%, 0.7%. That's 70 basis points. If you remember, we call basis points in the markets. But by the 28th of September, they had gone up by 1.4%. So the cost of government borrowing had risen by 1.4%.
And you're talking about from a low level to start with.
I'll say,
so I mean, 1.4 from
4.1. From 4.1. Yeah, so it went to
almost 25%.
Yeah, it went to 5.5% to borrow for 10 years. The British government could borrow for 10 years. Now, it affected the UK market first and foremost. But other government bond markets around the world worried that other governments would try and do the same thing. So other government bonds, prices going down, yields going up, happened all around the world, including America, etc., like that. And eventually the Bank of England had to step in on that 28th of September, so just less than a week after the budget, and say they were going to start intervening. Now, the fact that the Bank of England said they were going to intervene worked magic straight away. And that bond yield, that 10-year government bond yield, fell from 5.5% to back to less than 4% again in a straight line. And that shows you the power of the Bank of England. They have, and these central banks have huge power, but the politicians absolutely made it a terrible mistake. And guess what? 2 weeks later, Liz Truss resigned.
But what does it mean by intervening then? What did the Bank of England do to come and ride to the rescue?
They basically said they would intervene in the government bond market by buying more government bonds. But if you buy the bonds, the price should go up, the yield should go down, and the effective interest rate should also fall. And that's basically what they said they would do. They said they had the power to do it, and they would do it if needed. And just saying it actually had a big impact on the markets. Now, the equity markets at the same time fell, the FTSE 100 fell about 2.5% over the same period. So it's not a disaster particularly.
But the currency was collapsing.
Yeah, but the other markets around the world didn't move; they were still going up a little bit. But actually, the mid 250 companies, so the companies most affected by interest rates in the UK domestic economy, where we invested in the mid 250, as we've talked about before, the FTSE mid 250, that market fell 6%, and it's because interest rates affect smaller and mid-sized companies the most. So when interest rates are falling, that's good for those companies. When interest rates are rising, either by government bonds going up, that can work against them. But thankfully, the Bank of England came in and said they would stand behind the government bond market. It was saved a lot of pensions that were potentially going bust because they have liabilities that the higher the interest rate, the higher the liabilities they would have. And a lot of them wouldn't be able to fund paying their pensioners in the future. So they stepped in to stop a massive disaster. And it worked. It did work.
There were other things going on as well in terms of the long end of the gilt market, something called liability-driven insurance, LDI. We will do that in another podcast because that also contributed to the issue. But the fact is, interest rates rose sharply, prices fell, people worried about what their mortgages were going to be because they're linked to interest rates as well. It was a complete disaster. And as Mark says, the conclusion to the episode was first the Chancellor went and then Liz Truss went. So I don't think any of these reactions are particularly likely immediately. I think we're some way away from these things, but they show the power of the gilt market if participants feel that politicians are taking them for granted and talking the talk, but not walking the walk. As I said, in 2 weeks' time, we'll be doing a pre-budget special and we'll discuss with him what he thinks. But I don't think the stakes could be any higher than they are.
Now, I do recall right at the start of our podcast journey, you mentioned a book that had helped you during your learning of the equity markets, and it was called The Art of Execution.
Correct.
Now, Spice has gone to the author of The Art of Execution. And as a surprise to you, next week, we are going to have the author, Lee Freeman Shaw, on here as a guest to talk through all the psychology of investing that is in that book.
I think it'll be absolutely fascinating. And we'll work out whether CJ really is a rabbit.
There are many things I've been called in my life. A rabbit is probably the politest version.
I did have to bite my tongue.
So join us next week if you want to find out if you're a raider, as Lee Freeman Shaw, the author of The Art of Execution, comes and joins us. If you've got any questions ahead of those two podcasts with the guests the next 2 weeks, then please email us at
theartsofinvesting@ig.com.
And for that live interest rate decision, we're just getting it hit the tapes from the Bank of England. Spice, what have they done?
Well, we've heard that it's a knife-edge decision. They voted 5-4 in favour of keeping interest rates unchanged at 4%. No cut this month, but given that they voted 7-2 in favour of staying last month, this month it's 5-4. I wouldn't mind a little wager that they may cut 0.25% in December.
So no joy for you mortgage holders, but the savers are celebrating. Are we going to see another down week next week as we slip further away from the 10% target? Or will the bulls be back to reign supreme? Join us next week to find out.